Good morning, welcome to Jackson's. It's Monday, Thursday, the 1st of April. Well, the big news this week in the financial services industry, at least, is the publication of a policy statement by the Financial Services Authority. This is the latest in a series of papers under a general heading called the Retail Distribution Review. So it's a comprehensive review of how retail financial services, which takes in banks, financial advisors, and all sorts of financial institutions, how retail financial services is distributed, i.e. sold to the general public. Now, this is the most comprehensive review since the mid-1980s, when the Financial Services and Markets Act was brought into force. Now, it has been a process ongoing since mid-2006. There's been months, years of consultation, but this document finally contains the draft final rules for how people like me and the advisor in your bank or building society must operate. Essentially, there's three main cruxes of what is going to happen, and all these changes are likely to come in on 1st of January 2013. So it's only 2 3/4 years away. The first one, and arguably the most sweeping change, is the abolition of commission. Historically, people like me get paid a commission when we arrange a financial product of some kind for people like you. Now, you of course pay that commission, but indirectly, and historically the payment of that commission has been very opaque. It's been wrapped up in product charges, annual management fees, extra allocation which is given in one hand and taken away on the other. Very much smoke and mirrors, and certainly not the modern way of doing things. As of 1st of January 2013, commission will be abolished. That will no longer be allowed to happen. So providers of financial products will need to make them clean. So you have a list of charges for the product itself, but none of that will be paid to the advisor. Instead, what is being proposed and likely now enforced is something called advisor charging, where the advisor and the client will need to agree the cost of the advisor's services up front. Now, how they will be paid, there's probably a few options for that. It'll either be sort of by invoice or maybe taken from a regular premium, say. But the point is, it's agreed between the client and the advisor, not between the provider and the advisor, with the client having little choice in the matter. This is designed, of course, to remove product bias and commission bias, where an advisor might choose a product which pays more commission over a more suitable product which pays less commission. So it can only be a good thing. We've been working on this basis for years now, where we agree a fee for the various stages of our process, and that's agreed up front and usually taken on completion of the advice round. So this is no major change for us, but it's a sea change for the industry, and it's a good one. The second main thrust of the Retail Distribution Review is the reintroduction of polarisation. It used to be you had two types of advisors, independent advisors and tied, who used to work for banks or building societies or insurance companies, like the man from the Prue, for example. Then 2 or 3 years ago, that all got swept away and became a real confusing mishmash of different titles, including, for example, the difference between independent and whole of market. Well, they sound pretty much the same thing, the difference being that if you were independent you had to offer a fee option, whereas if you were whole of market you didn't. But clients just would struggle to get their heads around that. It certainly would need to be explained very carefully, whereas clients always understood that an independent advisor was just that, independent, able to source products from the whole market. Well, mercifully, polarisation is coming back under the Retail Distribution Review, and there will be two types of advisors, independent and restricted. Now, I love that word because it says it how it is, and I think it's a good thing. The Financial Services Authority have watered down a little bit the necessity for a restricted advisor to go through a script explaining in detail what the restrictions are. And by taking that requirement away, there's potential for abuse there, with restricted advisors instead holding themselves up as having searched the whole market but decided to restrict themselves to a core of key providers. Well, the fact is they're restricted, and they're going to need to be able to say that that's what they are. We will of course remain fiercely independent, as we always have been, working for you rather than for any provider. And the final thrust of the Retail Distribution Review is going to be qualification. Currently you can do this job on the basis of 2 or 3 GCSEs, which I think is a travesty. We handle very large amounts of money for people, and surely we should be more qualified than an average 16-year-old to do that. So the minimum qualification level is being raised to QCF level 4, which is roughly first year degree level. Although it's evident to me at least that within a few years it will rise to QCA level 5, which is degree level or chartered level, which I think is about time. Now, I'm not quite there yet, just a couple of exams away, but we're all working very hard to get to chartered level. But it's a good thing. Raising qualifications raises professionalism, there's no question about it. Now, there is a lot of bleating in the industry about experienced advisors, people who've been in the industry say 30 or 40 years, why should they have to sit exams? Now, I have some sneaking sympathy with that, not least because I know some superb advisors who have done a brilliant job for decades for clients, and understandably don't want to sit 3 or 4 exams now. But as a whole, I think the only way to raise the standards of the industry is to increase qualification levels, so we welcome that too. So the industry, having had 4 years of consultation, is now waking up, I think, to the understanding that the Retail Distribution Review is happening. But for you, the client, this is a really good thing. This will weed out a lot of the cowboys and crooks in our industry who have given us a bad name. It will weed out high initial commissions, which you pay for, but don't really see because of the opaque charging structures of some products. It'll sweep all that away so that your relationship will be with your advisor, and the terms of that relationship will be agreed up front. The Retail Distribution Review, the RDR, is a good thing, and we welcome it with open arms. And we look forward to seeing the changes in the industry in the next 2 or 3 years.